Hi, welcome everyone to a special edition of Story Trading. Today we got the CEO of QC Copper and Gold, QCCUF here in the US exchanges. First, a disclaimer, Story Trading is not an investment advisor. That goes for all of our guests and contributors unless they say it otherwise. Investing in securities involves significant risk of loss. This presentation is being recorded. It's going to be made available first to our VIP members who could not attend live today, and it's going to go up on YouTube next week. So first, just quick, what is a story trader? What is story trading about? Story trading is about understanding market pricing, aka the story behind the trade through the lens of the four pillars: fundamentals, catalyst, sentiment, and technicals. We have an upcoming app coming out, which will be the place to discover, collaborate, and validate market-moving information through crowdsourced research and social collaboration. If you want to be sure to stay abreast of all the developments there and be on the wait list, please go to storytrading.com and put your email address in there. QCCU is actually a VIP pick that was presented by contributor Chris Hampton, who's on the call today. So what we do often is when there's a VIP pick, we'll invite the CEOs of the companies to come and present to us. So if you go to the website, click on VIP performance, you can see the performance of all our VIP picks, which is dramatically outperforming the market by almost 4 times. So everyone's doing a great job with those picks. So QC Copper and Gold, it trades under QCCUF. The last trade is 0.145. And we talk about those 4 pillars: technicals, fundamentals, sentiment, and catalysts. I just want to quickly review to give people some context. Here's the chart. You can review that on your own. That's the technicals here in the past year. Fundamentals, it's a pre-revenue company. So I threw out the cash position, enterprise value, very low, 11 million. And you can see the outstanding shares that were going up there as they fund their pre-revenue development. So with that, I'm going to stop my share. Stephen, thank you so much for joining us. We look forward to your prepared remarks, and we'll have a Q&A afterwards.
Okay, well, look, thank you very much, Ben. It's a pleasure to be here and to meet all of your colleagues here. Can you see my screen okay?
Yes.
Okay, good. So I'm going to run through my presentation. And I'll look forward to Q&A at the end. But I'll get right into it. My name is Stewart. I am the CEO of QC Copper and Gold. And this company is about 2 years old, and we started it by acquiring what was a legendary mine. It was Falconbridge, which is now Glencore. It was their flagship copper asset that produced for over 50 years in the heart of Quebec. And it was shut down in 1991 due to low copper prices and a strike. And since then, it had been owned by a private Quebec family who have been tinkering away at it, but never had the ability to take it to the next level, which is commercial production. And so we developed a relationship with this family over a course of a few years. In fact, my vice president of exploration known this family for 30 years, which was a good starting point. Then it took us a few years to convince them to sell us the project. And we successfully acquired it in 2019. And ever since then, we have been trying to de-risk and redefine this once very large series of high-grade underground mines and vein systems into what we see as an open pit deposit. And so what I mean by that is we are going to be cutting a big hole into the ground as opposed to going underground, and we're going to be extracting that vein material. But in addition to that, and what's really critical to the story is we see that this mineralization is disseminated. So for those who you are not mining experts, it's fairly unusual for mineralization to be disseminated outside of the vein material. When you're going underground, you're precision mining, you're going after a very specific rock. There are occasions, and there are a few examples which I'll point out, but sometimes the mineralization leaks out into the host rock. And when that does, and if it's near surface, that's when you get an open pit. Falconbridge did not see that when they were mining this thing, or they figured it wasn't economic at the time. But now, with copper north of $4 US, this becomes quite an economic situation. The key milestone is going to be in the next, I would say, 45 days, we'll be publishing our 43-101 resource, which will have our tons and grade and strip ratio. That's going to be our resource estimate. That is going to define what this project is. That is what the market is waiting for. And I'll talk about that throughout this presentation. So this is the forward-looking statements. I won't get into that, but I will be making forward-looking statements. This is before I get down to the project, very quickly, I'll tell you a little bit of myself and our group. We've got a broader group based out of Toronto. We're called the OR Group, and it's a group of entrepreneurs that cover all facets of the resource exploration and development business, from obviously the geology, the engineering, but also the finance, marketing, legal, CFO, everything it takes to identify, discover and delineate a resource and then operate it thereafter, where we offer the full complement. We typically identify a commodity that we like, such as copper or gold, and we build a company around it. We've got 6 publicly traded companies. They're all listed there. I would say QC Copper is our flagship company in the sense that its asset, the Opemiska, is far and away the largest deposit that we have to date. Corporate overview. This is information. Obviously, Ben put up a more detailed trading metrics on us, but what I'll point out to you is obviously our market cap. These are all Canadian figures, by the way. Our market cap in Canadian dollars is just over $20 million. We've got about $4 million in cash, and we also have about $10 million in shares in a company called Baseload Energy, and Baseload is part of our portfolio. QC Copper sold an asset to Baseload for $1 million valuation, and Baseload's had a 10x in the last year. So that position is substantial for us. We will be monetizing it. I will be selling that position in Baseload so that we don't have to dilute ourselves further at a certain point in time. So the moral of that story is, I think if you strip out our cash, you strip out our position in Baseload, you get our enterprise value, round figures, $10 million Canadian, for what I think is going to be the most interesting copper with gold asset in Eastern Canada. As I said, we're redefining this. This is going to be a sizable resource. But again, everybody, the market, because the market doesn't know. Why are we so cheap? Because the market doesn't know what we have. We get $10 million, where I think we should be 5x to 10x really relative to the deposit, which I believe that we can deliver in the very near term. And again, that's a forward-looking statement, and our resource statement will define that. Where exactly are we? We're in the district of Chibougamau. Chibougamau is right in the heart of Quebec, which is by no other definition a world-class mining jurisdiction. We've got infrastructure, we've got community relations, everything you need. The rail comes right to our site. So why is this so important? Because when you're building a mine, infrastructure is oftentimes the largest CapEx component. We don't have to build any roads, rail, power, etc. It's all there. So that just is going to enhance our project economics. As I said, our mine, the Opemiska, produced 1.1 billion pounds of copper and about 1 million ounces of gold. The Chibougamau area right here, as you can see, produced a little bit more than that over its history, but you can clearly see that our asset, the Opemiska, was the dominant asset. And this, I just drilled down into it here. This is the Chibougamau district as a whole. This is our primary asset, the Opemiska. I'll point out the Springer and the Perry are the 2 primary mines that we've focused on to date. In the future, when we're done defining and putting a pin in what the tons and the grade are between these 2 assets, we'll move on to our Robotai and Cook, which were the 3rd and the 4th mine that was operated by Glencore at the time. Last, I'll point out very quickly, we just made an acquisition, a very strategic acquisition of about a 500,000 ounce gold deposit in an open pit called the Roger. It's a little further east, and it's more in the, call it Chibougamau proper area. We're over here in Chipay, but this is all, as the crow flies, about 15 kilometers away. It's a very strategic asset, and we just acquired that. I won't get into this slide. I'll just bypass it here. But this shows the previous production. Again, I'm going to focus in on the Springer and the Perry. That's where the bulk of this, in fact, that's where all of the resource we'll be publishing. Let's just call it by Labor Day. We'll be focused on, and this is the blue sky. This is the Gwillem fault here. I'll show this on the next slide, but this is where all the good stuff comes from. The fault is nothing more than a crack in the earth. And through that fault, there's fluids that come and they deposit copper and gold mineralization. I won't get into the geology heavy. This is what it looks like. This is just a model But this is the Gwillim Fault. We've got 13 kilometers of this structure where you really want to be next to. And this is what our deposit looks like. These darker areas here are the high-grade veins, mostly what Falconbridge and Glencore were focused on. The big story in my mind is the little squiggly arrows that are coming out here in the lighter red. That's the disseminated material. So when you're building an open pit, you want to encapsulate certainly any material that was not mined by Falconbridge. And I'll note their cutoff grade when they were mining, it was 2.5% copper, meaning anything less than 2.5% copper, they did not mine because they could not make money at it in the context of the copper price at the time, plus underground mining economics. So there's a huge amount of residual copper and gold left over in the veins, plus this disseminated material. We think we're going to have a very sizable resource that is really going to wake the market up when we do publish it. Now, this concept of turning a high-grade high-grade underground mine into an open pit is not new. We're not reinventing the wheel. The two best examples, certainly in Canada, are Osisko Mines, Canadian Malartic, and the second is Detour Mines, which is now owned by Kirkland Lake Gold. This is in terms of size. This is the Canadian. The one on the left is the largest gold mine in Canada, 600,000 ounces. This one here, Detour, is the second largest gold mine in Canada. So it is our opinion that this is really the future of how mining is going to happen, specifically in gold and copper. We're just not finding these deposits like we used to 50 years ago, even 10, 20 years ago. So we're having to reinterpret the geology. And as I think metal prices go up, you're going to see more and more situations like this. And the third example I'll give is a project that we were directly affiliated with. About 15 years ago, we discovered what's called the Cote Lake deposit, which was acquired by IM Gold, and that's going to be a very large mine in the order of 200,000 ounces a year. It's currently being commissioned. That was the first project we looked at. So that was back in my career, at least, and that was a big success. So we're trying to recreate it here. So as I noted, I'll point out some historical intersections. These are intersections done by that private Quebec family. They were really, when they were evaluating it, they were looking to go back and sort of reopen the mine without a new idea. They were just going to mine the veins. And why would they do that? Well, they had pretty good intersections. You can see 30% copper over a meter. And up here's a wider intersection, 10 meters at nearly 5% copper. Now that is phenomenal grades, ladies and gentlemen. You very rarely see that. However, when you look at those intersections, but again, you look at a broader zone, and if you're fortunate enough, and if the stars align, you can get disseminated material. So in instance here, you can see 81 meters at a percent. So if you go wider than just the veins, you have the opportunity to mine disseminated, and that becomes relevant in an open pit. You do not necessarily want to be mining anything sub 1% underground because the economics don't allow. But when you get an open pit, all the economics changes, and anything anywhere near 1% is considered extremely high grade. In Chile, they're mining 0.5%. Out on the west coast of Canada, they're mining about 0.2%, and they're making money doing it. We think we can deliver a resource in the range of 1%. Give or take, probably maybe a little bit less, but still close to 1%. And our initial objective is going to be try to deliver a resource as large as we possibly can. We don't know what the tons in, but tons are going to be very important, as well as the strip ratio. This is something that I was referred to. I think this is important. It sort of lends itself to these shorter intersections due to the larger intersections. When Falconbridge was mining it, they were undersampling it, meaning they would drill 50 meters, but they would only sample a single intersection because what they were mining was very visually obvious. But when you do drill the hole that we twinned that same hole and assayed the entire 81 meters, and you can see it's mineralized throughout. So this is just a cross section intersecting the veins, but also the material in and around the veins that becomes ore as opposed to waste, which is important when you're looking at an open pit. We have just completed 20,000 meter drill campaign. We raised almost $6 million of capital in 2020. 2021's all been about deploying that capital. As I said, that program just wrapped up about 30 days ago. We have cut and sent all of the cores to the assay lab. We're about halfway through reporting the assay results, where we've seen continued 100-meter plus intersections. over with ore grades, which is fantastic news. And we've got about quite a few holes to go, and that will be culminated in a 43-101 resource. A good deal of that drilling is going to be used to validate the historic results. So there's a lot of work from Falconbridge. In fact, over 800,000 meters of drilling plus 300,000 assays, which we are what's called validating by doing a lot of twin holes to sort of make sure that that data is real and it's good. We know that it is. This process is going to allow us to leverage the massive database that we have, which will allow us ultimately to get a bigger resource quicker. Now, this is what the resource looks like. You can see these are on the west side here is the Springer mine, and the east side is the Perry. What you see in the lighter gold is the resource as we've defined it using the Falconbridge data. That's the 300,000 assays. The darker gold is what's been extracted. Obviously, this was mined, and so we spent a good deal of time and effort detailing what has been left over so we can ultimately get a net amount. And what you see in the little black pins, that is the drill program that we just completed. We have not fully built that model. So this model, as you see, will be updated as a part of our 43-101. We expect this to grow quite significantly and look a little bit different once that 20 kilometers or 20,000 meters of drilling is complete. I will point out the saddle zone. Okay, this is going to be a very important part of the work we did. The saddle zone, the saddle basically means the area between two underground mines. Our objective is to make these two underground mines into one large open pit. I believe we'll achieve that. We've released results in this saddle zone here by doing drilling into virgin ground, which was never mined, but we've shown, our most recent press release showed that we're getting nearly 1% copper over 80 meters in the saddle zone. We do believe that this in effect is mineralized, just it was never mined because it wasn't necessarily economic in the context of underground mining, etc. But we do believe, and I'll just sort of, and this is the intersection here, you can see almost 80 meters at 1%, but this is conceptually what we want to do. This is the area for expansion. We think in this resource report, we will absolutely encapsulate the saddle zone, and that is going to be significant because not only will that allow us to be more efficient in our mining, capture a lot of the resource that we now know is there, but it will also allow us to go deeper on these two existing resources. So given our model from 2020, we've only taken the mining to a depth of about 280 meters, but if we can encapsulate the saddle zone, that will allow us to go deeper and capture this resource, which we know is already there. So I think that is going to be a big area of interest. And then post, let's call it beyond the maiden resource, we believe there's mineralization to the east, what we call the eastern zone. And then, of course, we're going to be focusing on potentially more. It's possible we could go back underground once we have these open pits, but also there's mineralization on the Robitaille, which is over here, and it's quite analogous, very similar to these two mines, and the Cook, which is a little bit different a mine. It was operated by the same group, but it's actually a gold mine with a copper credit, whereas all the Springer, Perry, and Robitaille are copper mines with a gold credit. So catalysts moving forward, I'm just being mindful of time here because I want to leave as much time open for Q&A. We've got our assay results are ongoing. Resource is coming out, let's just say late August, but maybe Labor Day for sort of attention purposes. From there, we'll continue. We want to expand this resource and then put economics on it. So this first maiden resource is just the geology, understanding its scope, its size, its grade, and then we have to define the extraction economics. We believe we can deliver that by the end of 2021. And then from there, it's really taking what could be, let's hypothetically say it's 100 million tons. We think there's an opportunity to take to 150 million tons, maybe 200 million tons. Again, those are forward-looking statements, but that's what we expect. And that's what we see in this environment, especially considering that we have 13 kilometers of the Gwillim Fault and a third and a fourth mine that we haven't even considered. Final points, I won't get too much into this, but this is what's called the crown pillar. We believe that a crown pillar is the supporting structure on top of a mine that was left over so that it doesn't collapse. This mineralization, these veins, high-grade veins come right to surface, and we think we can, we don't think, we know, we see them there. That's going to, these high-grade starter pits are going to increase our payback, increase ultimately our IRR and NPV economics. That's a huge advantage that this project offers. Last point I'll make on a technical level is metallurgy. And metallurgy is probably the most overlooked thing when evaluating a mine. If you can't separate the metal from the waste, forget about it. Your project's worthless. We know the metallurgy here is good. They mined it for 50 years. We're updating the work based in an open pit scenario, but we have a very good confidence in that. Social license, excellent. There's no better place to be than Quebec. I'll answer any questions on that in the Q&A. And the last point I'll make here is if you can come in at 1% copper, we created this slide because not everybody understands inherently the economics of copper. Most people understand what a 1 gram gold deposit is. And everything in the mining business is evaluated on a per ton revenue that you get from a ton of rock that you have to move. 1 gram gold is about $60 US per ton. Copper, 1% copper is nearly $100. So it's 71% more valuable on a basis. So if we can come in at 1% or anywhere near that, we've got a very interesting situation on our hands. We're not getting valued, as you can see here. These are some of our contemporaries. They're valued anywhere from almost $1 billion up to us 20, and 10 of that 20 is cash and marketable securities. So I think it's a good entry point. I've been buying the shares that, I probably spent $150,000 of my own money. It's publicly disclosed, buying shares in the last 3 to 4 months. This is our Roger project. I noted it off the top. I won't get into it because we're not focused on it yet, but it's a very good deposit. We bought it at a very good price. And last, this is our position in uranium. So not only are you getting exposure to, I think, the best asset, copper gold asset in Eastern Canada, you get a uranium kicker, as we say, by our 36% ownership in a nearly $40 million company called Baseload Energy, which is led by one of the best young uranium geologists around. This is our team. Point of Charles Baudry, he is our key technical guy. He's known this asset for decades and has been working on it. He's been bugging me to buy it, and finally we did a couple of years ago. And that's it. So I'm very pleased to answer any questions. You can find lots more information, historical, technical reports on our website, QC Copper, and there's my contacts that I'm always available at. So I'm trying to be mindful of the time, Ben. I know I probably went over the allotted, but look, I'm here for as long as anybody has any questions.
Awesome. Thank you so much, Stephen. Usually I take the first shot at the questions, but this time I'm going to defer to Steve Kessler. He's a special guest here today as a geologist. So I'm going to have him ask away his questions first.
Well, thanks, Ben. I guess I'll stick my video on. And thanks, Stephen, for that presentation. That's really interesting. Let me ask you just a few questions about the copper gold situation.
Sure.
You're quoting your copper values, including the gold in it. What can you say about the recoverability of that gold? What do you know about the mineralogy of the gold? Is it present as native gold? Is it in solid solution in the chalcopyrite? Will it follow the copper in the con? Do you have any information on that?
We are upgrading redoing the metallurgy. So we will have a metallurgical report done and published with our PEA, which is what we expect to have at the end of the year. So we're not going to have updated metallurgy for this 43-101 report because it's just not necessary. I can tell you that the concentrate that was produced for 50 years was a very clean concentrate. It was 25% copper with about 0.25 grams gold. And that concentrate was sent to the Horn smelter, which is in Val-d'Or, a couple 100 kilometers away, which again was owned and operated by Falconbridge at the time. I am not your guy that can speak to the genesis of the gold and whether I don't believe it is native necessarily, but whether it came before or after or together with the copper, that's a question that I'll have to defer to Charles Baudry. And but I can certainly have that question for you. But in full disclosure, I am not a geologist such as yourself, Mr. Kessler. So I hope I answered your question sufficiently.
You're doing just fine. I bring it up though because 30% of your valuation is the gold, and so that gold is going to have to follow the copper very faithfully through the mining process and the concentrating process. And, my guess is they're coeval, they formed at the same time, but it's not uncommon in a process, in a mining situation like this, for a fair amount of the gold to be left behind. It just isn't recovered. So I think in the long run, that's going to be an important issue for you to kind of reassure your investors about. Another issue about the copper gold grades that you're quoting, do you think there's any nugget effect going on? You know what a nugget effect is in a gold deposit, where you've got one high grade and everything else is low grade, but the average sounds pretty good. In some of those long holes you're showing, there seem to be only a few areas with copper kicks, which makes me wonder just how barren the rest of that hole is.
No, I would say I certainly know what nugget effect is. We do not suffer from the nugget effect. What we see here are two distinct styles of mineralization. We see the veins, which range anywhere from 1% up to 30%, very, very clearly. Outside of those veins, in the halo, and we see the halo effect coming in both the hanging and the footwall, and we see it's relatively equidistant from the vein. We see a very clear pattern. The average grade of that halo comes in anywhere between 0.4 and 0.6. So that is largely where we see the grades coming in at the halo effect, and that is a copper equivalent grade as well, which includes gold. So there's no question that's where we see the grade coming in on the disseminated portion. There's going to be, I would say, roughly about 75% of our payable metals will come from the disseminated material. Now, we think that we can get that average grade up significantly, up into the 1% territory, by including the residual material in the veins. So that in effect juices up our average grade. Now, I should note, which I didn't note, is that we already have a model, and we know I have a very good idea of where the total average grade it comes in at, and the tons come in at, prior to this drill program that we started this year. So we are coming off a certain level of confidence in terms of grade, in terms of size, in terms of strip. And I'll note that this is not a model that we created. The independent 43101 group, which is called P&E Mining, one of the most reputable groups here in Canada, they created this model for us, and they are updating the model and going to be publishing it as an independent technical report soon. So we have a very good level of confidence in both the grades where we see it in the halo, and also the grades within the veins, if that answers your question.
Yeah, you're doing a very fine job of it. Well, will you have some feeling for how much just total dead rock you have in there when you give us this resource estimate?
Absolutely.
And to what degree that'll affect mill feed? Because, you know, if you've got a lot of dead rock, it's still going to kill an open pit.
I think that we have a very good idea of what the mine plan would be, given that the model shows by and large that the halo effect is equidistant to the vein, and it's on both sides. And so we can identify where this ore is within fairly good confidence, which is going to assist in mining. Now, anything outside of that, by and large, all else equal, will be considered waste. So we know we have a good idea. So to answer your question, we do not think this is like a nuggety effect quite at all.
Okay, last question. Thanks for all this. Do you see much zoning in the system? Arsenopyrite is present. Are you seeing any arsenic that would affect your cons? And are you seeing any zoning that would affect your overall approach to valuing the deposit?
Short answer is no, but there's always some nuance in there. We only really see arsenopyrite when there is a gold vein, and it's something we haven't really focused on. There's actually, by and large, most of the vein system goes northeast to southwest. However, there is a cross-cutting gold structure that comes sort of north-south, which we haven't really drilled proper, because the orientation of our drill is really meant at the main vein systems. But where we do see the arsenopyrite was in that gold vein, which has an awful lot of potential, but we haven't focused on it on this campaign. We not suspect, but we plan in our next drill program, we'll pay more attention to the gold, and we don't see a lot of, interestingly enough, and maybe that speaks to, did the gold and copper come together? Is it a single event, a double event? Within that arsenopyrite vein, we don't see a lot of copper, interestingly enough. And also when you get to, for example, our fourth mine, our Cook mine, the further you get away from the Gwillim fault, the less gold you get. So the Cook mine, in a sense, it inverts. So you get gold rich with a copper credit, but the closer you get to that controlling structure called the Gwillim, the more copper you see.
Yeah, you've got an interesting possibility here. You could almost be onto a new type of deposit. So this zoning will be the key to understanding it.
Well, thank you. I mean, we have tried, we've searched the world trying to find an analog, and we don't really find any proper analog for this style of deposit. Obviously, over in Chibougamau, over to the northeast, we do see very similar styles of mineralization, but they haven't done a lot of work on the wall rock. They always mined it as a vein system, just like this mine was. So it's entirely possible that this style of mineralization exists over in Chibougamau, or it may not. We don't know yet.
Ben, I'll turn it back to you.
Great, thank you, Steve, so much for that enlightening conversation. If anyone has any questions, I want to remind you, you can throw it in chat or raise your hand. So while you think about your questions, Stephen, I'm going to get started with a couple of my own. So you talk a lot about this 43-101 coming up in 41 days, which is going to be like a resource estimate. But you've expressed a lot of confidence that you pretty much know what's going to be in there based on prior data. So I wonder, what, you know, is this basically assumed by the market at this point? Like, why should this make a difference? You seem to have a lot of confidence of what that's going to show.
Well, let me just clarify one point. I have a great deal of confidence in what this model looked like before this 20,000 meter drill program. Okay, because we spent 2 years modeling the existing data, which includes the Falconbridge data, but also includes the drilling done before us by that family. They drilled in various eras from 2010 up to 2016. And then we did our own initial drill program in 2019 to drill test our thesis to see, is this disseminated? And we came out with a whole bunch of whopping intersections, some really impressive intersections. So up until, let's call it 2020, we modeled it and we had an excellent degree of confidence in what it is: grade, tons, and strip. Truth be told, I don't know with any degree of certainty what it's going to say come Labor Day. Okay, let's just use that date because we have not built the updated model based on this drilling. As I've noted, we've probably released, I would say, 12,000 of the 20,000 meters from this program in terms of drill results, but we are not necessarily building this model in real time. We are waiting. In fact, we're waiting until all the assays are in. I suspect we were planning the assays to be in our possession and in the QP's hands, who's creating this report, in about 30 days time. And from there, they will be creating this updated model. So hopefully that's clear, but we know what the baseline is, 2020. This program is growing it and also validating it, bringing that model into the 43-101, because some of that data needs to be modernized, if you will, and tested. You know, we trusted it because it was Falconbridge's data. They were mining it. They're not some junior flogging results. If they reported incorrect results, they lost money. So we had a good deal of integrity of the data, but you got to trust but verify, as they say, and that's what a good part of this program is. So we do have a good deal of confidence at a baseline, where the hope is and where the expectation is that it's going to grow, hopefully substantially on top of that.
Okay, great. So, you know, what I'm really trying to get at is what the market needs to see, right? Is it that resource estimation, or is it what comes after that by the end of 2021, the extraction economics and the metallurgy reports? But I'm going to come back to that. Chris Hampton is raising his hand. So go ahead, Chris. I think you have audio.
Yeah. So when I first started looking at you guys in one of your old videos, you said that you think you might be you said that you thought you might be sitting on $7 million worth of metal. That was, I think, copper was trading at $3 or $3.50 back then. Have you validated that, or has that number gotten larger?
I think it has the potential to get larger. Let me, two things, Chris. First, thank you for facilitating this opportunity for me. I remember speaking with you, and I'm glad for the introduction with Ben. So
yes, thank you, Chris.
The other thing is, yes, if you do back of the envelope, I did say $7 billion, I believe it was, but it was billion. I think you said million, but
Oh, yeah, definitely billion.
we're talking orders of magnitude difference. But yes, so that was probably an assumption based on us coming in at 100 million tons and 1%. Now, obviously, again, that's a forward-looking statement, but that's our goal for this first pass. And if we do that, that's again, I'd have to double check my math, but approximately $7 billion in gross metal value in copper. Now, that doesn't mean that's profit. Obviously, it costs money to build it and operate it. You have operating expenses, but that's a great top line to start from. And truth be told, if we do come in at 100 million tons, which would be, really a home run if we did, even if we come out with 70 million tons, it's going to take the market by storm. When you look at, there's really just no comparables, certainly not in Canada. Now, if you wanted to go to Peru or Africa, you may be able to find some comparables, and those comparables are trading anywhere from 60 to $80 million market cap valuation. But those are places that I, personally would choose not to invest too much money in there. There's really nothing in a safe jurisdiction like Canada that offers that sort of size, and I think we're just beginning. I hope I relayed that confidence that this isn't as big as it's going to get. This is just the beginning. It's really early days in the development of this story. And I'll also note that, there are other projects out there in the copper space that are drilling kilometer-long intersections, which are called porphyry deposits. And certainly Mr. Kessler will be very familiar with those. And those are eye-popping to get a kilometer long intersections. However, those are totally different styles of mineralization. Oftentimes you find them in Ecuador. They used to find them in Chile, but those are probably long since exhausted. But I'm sure there's a few more there. But the point I'll make is that while this is not a mega multi-billion ton resource, it's sizable and it's got a good size and the economics is there. And why I think that's important is this can actually be developed not just in this cycle, but certainly in the near term, whereas these porphyry deposits require $5, $6, $10 billion worth of capex. Not going to be built this cycle. So maybe one if they're lucky, but certainly not multiple. This project has the opportunity to be fast-tracked because it's in Quebec, because the infrastructure is there, and because it's near surface and well-defined.
Do you have a sense of your startup costs?
Not yet. Obviously, we have a sense. I won't talk about them publicly. We absolutely have run our own model. And the reason I don't talk about them publicly is because I'm technically not allowed to speak about economics until it's defined under the 43-101 system. We will have those preliminary numbers published in our PEA. There's not a really lot of guesswork because there's a lot of holes that have been dug in Quebec on the road. So we know how much a hole digging costs. We know how much a mill costs within a margin of error, of course. So it's always a complicated affair, but we do have back of the envelope, and it looks, if we can come in anywhere near the numbers we're talking about, let's call it 0.8 to 1% or 70 to 100 million tons, I can assure you that is an economic deposit.
Okay, I have two more questions. Back around the end of March, I think you had 5 million warrants expire and something like 20 or 30 million private placement shares go free trading. Just a huge number of shares come to market. Do you have a sense of how that's progressing? What percentage of those private placement clients might have turned over their shares or might be holding on to them? Or just some sense of, there's obviously some supply coming on the market.
Yeah, well, I can't speak to the nitty gritty.
Yeah.
But I can tell you that all of our shares are free trading and have been for some time. So I suspect anybody who wanted out for whatever reason, obviously you do it to make money. And I think we've made our shareholders money over the past 12 to 18 months are out. I think by and large, most people are holding and waiting to see what this resource says. Let me be the first to tell you that I do think this resource is going to be very positive, but I don't think it's going to be overnight. So if we release it on Labor Day or the day after Labor Day, the Tuesday, for example, we're not going up 5 or 10x on Wednesday. But unfortunately, that's just not the way the market works. But what it will do is it will define something, but it will take time for me to go out there and communicate and show the comparables. What do we have relative? Now, I'm not saying we're not going to go up. I do think we will go up. Will there be people who sell? Well, of course there are. Everybody's got a different strategy, but I think the smart long-term money, which is the money that I prefer best, sees the opportunity. It's not just a 25% or even a 2-time. We're going for 10 times our money on this deposit easily from where we stand today.
I don't doubt it. I'm going to scratch my last question. That was great. Thank you.
My pleasure.
Great. Thank you, Chris. So I want to come back to what happens after Labor Day. You've mentioned a couple times that you think compared to your peers that this should be 5 to 10 times higher once this report comes in. But what happens after that? You mentioned a report, end of the year, extraction economics, metallurgy. How important is that? And might some people be avoiding the stock because of the economics that might show?
Well, sure. I can't speculate on why people may or may not choose to invest. All I can do is focus on putting out the work and developing these resources and promoting it at the same time, of course. There will be, I think, a re-rating that will occur over not too long of a period after we come out. We define the geology. From there, we're going to be doing 2 things. One is we'll be working hard on the PEA, which will define the economics. And why I think that's really important, I think that's more for the institutional clients, especially the analysts who love to have some numbers to plug in. I think the broader call it retail investment world likes to see the geology and understand how big this thing is. And then the more technical crowd really wants to plug an IRR and an NPV and get into the strip ratios and talk about mine plans, et cetera. So I think this brings us into the institutional level. I think we will have money chasing us. I think we will, and we do have money chasing us. We have no shortage of opportunities to raise capital. We're choosing not to raise capital at these prices because I think the company's far too cheap. We do not need the money. We're well enough capitalized at just under $4 million. And of course, we also have those baseload shares when the time suits us. So I think the first pass at economics is incredibly important. I advise all investors to be very wary of first pass economics. There's a huge margin for error on PEAs. 90% of them aren't worth the paper they're written on, but it does give you a scope. It's a scoping study, and it identifies challenges and areas to improve. I think for me, by far, the most important thing is to define the geology. I know the economics are fairly simple. It's never easy to construct a mine. The most important thing is the ore body there? And if we can do that, then everything else flows from it.
So you mentioned $4.50. It's economic copper. At what price, if copper drops for whatever reason, at what price is it no longer economic?
Well, again, I don't have those specific numbers until the PEA comes out. We will be publishing a range of values, sort of a negative base case and a positive case. $4.50 copper. It's highly economic there. It's probably economic at $3.50, but we haven't yet run those sensitivities. But I mean, look, anything with a 4 in it, it's a fantastic copper price. If you believe the so-called experts who get into prognosticating where metal prices is going, they say it's going higher and higher due to the the electrification and whatnot. I'd like to believe them, but the truth is they don't have a crystal ball any better than mine. If copper goes down to $2, we're not building this thing. Simple as that. Where the break-even point is, it's just too early in the game for me to say. And what I can tell you that this is an ore body. That I can tell you. How attractive is it? We still have some work to do to define that.
You had a nice video on YouTube. I forgot who it was that was interviewing you that came out a few weeks ago, but you mentioned that you don't plan to actually do the mining, right? You're at some point going to sell this to a larger company. So when does that happen? Is that before or after the extraction economics? You said end of 2021, you get that. Is that the end of the road for you? And then is there more to do after that?
Well, I mean, I think it's I always say that I will never build a mine, and because I've never done so, and I believe that the first time you ride a bike you fall, so to speak. And so I think by and large our industry is bifurcated between those who de-risk and define the geology, which is a very defined skill set, which our group, the OR group, is very good at. And then there's the building, operating, and extracting ore, metal from the ground, completely different skill set. and very rarely transferable. Is it possible that we could retool ourselves to build this mine if we had to? Sure, we could. It's been done before. Companies fail more often than succeed at doing it. So to sort of answer your question, it's my preference to build value by, many times, as I said, at 10x is the starting point when I start to consider, okay, let's sell this thing. We're not there yet. So again, a trade sale is, by all else equal, the best way for a junior investor and the company to create and hold value for its shareholders. Because if we were to build it, it would take a couple of years and there'd be ups and downs and people may lose money. But if we can sell it, then you put a pin in it and people can exit, including myself. I'm a significant shareholder and I paid cash for every single share I had. I got no free shares in this company.
Oh, wow.
So, I'm highly incented to behave in accordance with our shareholders. So again, I don't predict the future. We have to, at the same time, you have to present a fairly credible response to anybody, mining, or a credible threat to build the mine. And we can always do that, but our preference, let me be clear, our preference is to do a trade sale. When it is, Ben, I don't know, but it's not immediately.
I understand that, but so you're saying there's a possibility you would even explore selling it after the geology report and before the extraction economics? I'm trying to, what's the further upside is what I'm trying to quantify, right? The comparisons you gave of 5 to 10x, I think you said. So what's the additional possible upside if you wait for the extraction economics report?
I think this is $100 million company. If the report comes out as expected and things go as planned, I think we have the opportunity to create that sort of value, which is starting at 5x from where we are today. And then what we're going to do, we're not going to wait. Waiting and hoping is not a strategy. We're going to build it. So we're going to build on what we're going to planning to build on in September, and that is grow it and further de-risk it. And then maybe copper price continues. We still haven't really hit the M&A cycle, which I have been very vocal about saying it's coming. It's inevitable. That's the only way this industry survives and thrives, is by big guys snapping up the smaller fish like us. And when that happens, all of the metrics that we're talking about go completely out the window. They make huge mistakes like they did in 2011 and 2012. And the smart junior mining companies are the beneficiaries if they can exit at the right time. So again, I hate to get into forecasts and everything, again, is a forward-looking statement, but this deposit, as I know it, is a 9-figure deposit. And I think it can go up from there as we continue to de-risk it and grow it, which is important.
Okay, got a question in chat from Bart Watson. What are the environmental concerns or likely political opposition that might hinder your mine development plans?
Environmental concerns, is standard operating procedure for building and digging a hole in the ground. No matter where you are in the world, you're going to face environmental challenges, social issues. We've done an awful lot of attention towards achieving what they call now social license, which includes local communities, First Nations, getting the government on side. We've done all the right things. Now, when the time comes to build this thing, somebody's going to complain. I guarantee it happens every time. It's unavoidable, whether you're in Papua New Guinea, Guinea in Africa, or in Quebec. And so that's just the way it is these days. And so we have begun our baseline environmental work. So it's just all about getting there early, checking the boxes, communicating with the First Nations and the local communities, which is key. And I'll say that in Quebec, and when I had a slide there that said Quebec's the best mining jurisdiction in the world, and it's not just a saying, it's the truth. They are a mining culture. Okay, so when you live that far north, there's forestry, or there's mining, or there's unemployment. And so, and as I also pointed out, that this town of Chapet was built in and around, or on, I should say, the Opimiska, so that they grew up around this mine. They have welcomed us. If I go to this slide here where I had a social license, I think I'm still sharing my presentation. Yep. But this is a small town. There's not more than 200 people in and around the town. Looks like half of them showed up to this. We have the support of the Ojibwe, which are the local First Nations. They are a joint venture on all of our exploration work. We've got support from the mayor. We've got the Plan Nord in Quebec, which is a brilliant provincially funded infrastructure development plan geared towards building mines and extractive industry in Quebec. So, again, we are going to face challenges on the social aspects. We're going to face challenges on the environmental aspects, but we have the support. We've been doing the work, and there is nothing. I guess the most important thing is there are no red flags, no fatal flaws, I should say. There's nothing that within reason can't prevent this from moving forward.
All right, great, Stephen. I don't see any further questions. So I want to remind people before you leave here, for future events, you can go to storytrading.com, click on VIP events. We have another, Chris, I'll come back to you. Chris has a follow-up question. So let me just go through these couple slides first. We got another CEO coming up July 21st from Dario Health. You can follow us on Twitter and YouTube to get some updates there. And also if you're a VIP member, we can continue collaborating on this company in the QCCUF research group. So with that, let's take a final question from Chris. Go ahead.
Stephen, this is a little, I don't know, I'm asking for your expertise here as much as information about QC. Recently, I read a study someone did, I think it was on junior uranium miners, but they looked at where their stocks traded vis-a-vis their net present values. And this study showed that the mean, I think, was about 40%. Most of those juniors were at about 40% of their NPVs. Now, looking at your list of comparables on your presentation, we've got some, especially like those guys in Peru that are trading down towards 1% or 10% of their NPV. What are your thoughts on that? What would you expect for a good junior? I know NPVs don't really take into account just the risk of, will this project happen? I guess that's a factor, but I don't know. What could you say on that?
Sure. Well, I would say, first of all, you take all of those calculations and generalizations with a grain of salt. Typically, how they do it is they value it by NAV, net asset value, relative to the other people's book value, et cetera. So that's typically how it's done. And you see anywhere between, as you say, 0.2, 20% of NAV to, in a hot market, you see things trading above NAV. Where we are, in the uranium cycle or any other cycle relative right now, I don't know. I don't know what the common multiple is. However, there's a huge amount of variability in each of those NAVs. Now, you referenced the discount rate. That's a huge implication. I think my biggest problem is, and I'm classically trained in finance, is that I have a problem with NPV and NAV calculations, particularly with longer life projects. They just don't capture years 10, so on and so forth well. I think I think the industry would be wise to also encapsulate it, call it an undiscounted cash flow, which doesn't, it's also not exactly fair, but you can compare and contrast, because when you start getting banking revenue in years 10, 11, and 12, it adds zero to your net present value calculation. But some of these, this mine here we think is going to be a multi-decade mine. And so you're really getting nothing for the second half of its life, which isn't fair. So, I'm sort of just going on, but I think you have to take that with a grain of salt. Certainly, I think that is perhaps a useful tool for looking at the sector as a whole, but when you apply it to specific companies, everybody does their NPVs a little bit differently, and so on and so forth. Some people even model in a different copper price. So,
yeah,
I take all of that with a grain of salt.
Well, I'm glad I asked you. Thank you. That was a great answer.
My pleasure.
Great. Thank you, Stephen. I think no further questions. I really appreciate your time. We're going to be tracking everything. We'll disseminate this information to the VIP community, and best of luck.
Much appreciated, Ben and Chris, for facilitating this and for everybody's questions. And as I said, my contacts are on the website, email, telephone. I'm always happy to speak with shareholders or interested shareholders.
Great. Thank you.
Thank you, everyone.